Imagine, uh, imagine walking into a bank, right? Because you want to buy a house.
Okay.
And instead of giving you a mortgage loan, the bank manager gets up from their desk, drives over to the property, buys the house themselves with the bank's money, and then turns around and sells it back to you.
Oh, wow.
Yeah, with no interest rate, total shared risk. Today, we are looking at an entire global financial ecosystem that does exactly that.
Which is, I mean, it completely shatters the fundamental assumption most of us have about money. Because in the conventional modern banking system, we treat money as a product.
Right, like something you can just buy or sell.
Exactly. It's a commodity that you can rent out to someone else for a fee. It exists as an asset all on its own, completely detached from whatever physical thing it might represent in the real world.
So we're unpacking Islamic finance today, and we're using a really comprehensive academic paper by Mr. Nemesi from KCA University as our guide for this deep dive.
It's a fantastic source.
It really is. It maps out the concepts, the governing principles, and the actual real-world applications of a system that operates entirely outside the conventional rules of Western banking.
And, we should clarify up front, this isn't some obscure theoretical niche.
No, definitely not.
We are talking about a massive, rapidly growing global industry that strictly forbids charging interest, structurally avoids speculative gambling, and frankly, managed to weather the 2008 global financial crisis in a way that had the International Monetary Fund taking serious notes.
Which is wild to think about.
Well,
But to understand how a bank survives without charging a dime of interest, you really have to look at the philosophical bedrock of the system first.
yeah, you have to start with the why before the how. In conventional finance, the engine driving every single decision is profit maximization.
Pure and simple.
Right. But Islamic finance operates on a totally different engine. It's driven by balance. Under Sharia law, economic activity is actually considered an act of worship.
Wait, really? Just doing business is an act of worship.
It is, but, and this is a big but, only if it maintains a strict equilibrium between material pursuits and spiritual needs.
So you shouldn't be so hyper-focused on your business success that you completely neglect your community or your spiritual life.
Precisely.
The research is incredibly explicit about this balance between the individual and society. I mean, it actively promotes moderate consumption and outright prohibits extravagant spending.
And what really stands out there is that this rule against extravagance, it applies even when you're spending your own money on permissible things.
Right, you can't just buy a fleet of solid gold cars just because you can afford it.
Exactly. The underlying belief is that the Earth's resources are finite. Humanity has been provided with exactly what it needs, but only if demand doesn't just, spiral into endless, unchecked hoarding.
Which manifests in one of the really foundational pillars of this economic framework, which is zakat.
Right, zakat. It basically operates as a mandatory property tax, but it's specifically levied on accumulated wealth.
So not just income, but the wealth you're just sitting on.
Yeah, exactly. If your idle wealth reaches a certain threshold, you are required to pay a percentage of it. And those funds are structurally earmarked to be distributed directly to people in need.
Okay, let's unpack this with an analogy, because this really helped me wrap my head around it. In conventional banking, money is like a snowball.
I like this analogy.
Right. You pack it tightly, you roll it down a hill with compound interest, and it just gets bigger and bigger on its own. You don't have to actually do anything except watch it grow in your account.
You totally passive.
Exactly. But under this philosophy, money is more like a shovel. It's a tool. You cannot just lock all your shovels in a vault while the fields outside go unplanted.
You have to actively use the shovel.
You have to actively use it to plant a garden, engaging in real productive economic activity so that everyone in the community can share the harvest.
That structural push, to force capital out into the real economy to create jobs and trade, that is exactly why zakat exists. It prevents capital from pooling exclusively at the very top.
Because if you just hoard it, it shrinks.
Right. If you just hoard your wealth, it will slowly be depleted by the zakat tax. So the system highly incentivizes you to invest that money into productive ventures.
And because the core philosophy demands that wealth be tied to real productivity, it creates a pretty rigid boundary around what financial activities are actually allowed.
Yeah, the biggest boundary being the strict ban on riba.
And riba essentially translates to usury or, interest. Charging or paying interest on loans is absolutely forbidden.
And the rationale here goes much deeper than just like a religious edict. Taking interest implies extracting another person's property without giving them anything of equivalent value in exchange.
Because money doesn't actually produce anything on its own.
Exactly. You are getting something for nothing simply because you happen to have excess capital.
It also completely kills goodwill lending. I mean, think about it. If charging 5 or 10% interest is just the accepted norm everywhere, nobody's going to lend out money just to help a neighbor or a struggling business.
Yeah, everyone just expects a guaranteed return.
Right. Beyond the social level, the broader economic implication is that a dependence on interest actually discourages people from building things.
Oh, absolutely. If you can simply lend your money out and watch it grow totally risk-free, why would you take on the hard work and risk of investing in industry or agriculture or commerce?
Why bother planting the garden when the snowball just rolls itself?
Exactly. Interest inherently keeps capital out of the productive sectors of the economy. It also tends to exploit the most vulnerable because, the lender is usually in a position of wealth and the borrower is operating from a position of need.
But riba isn't the only prohibition. The framework also bans garar and maysir.
Yeah, so Gara refers to excessive uncertainty or ambiguity or even deception in a contract, and Macer is gambling or speculative trading.
So what does that actually mean in practice?
In practice, this means no betting on the market. You
Yeah.
cannot engage in short selling where you sell a financial instrument you don't even own yet in the hopes that the price drops so you can buy it back cheaper. It also outright prohibits derivatives, like forwards, options, and futures.
Because from the perspective of Islamic finance, those instruments are entirely detached from real, tangible assets. They were basically bets placed on the future price of another bet.
Yeah, it's just financial engineering.
The system requires everything to be tied to the physical economy. There are also absolute bans on funding anything considered haram.
Right. A Sharia-compliant bank will not provide capital to businesses involved in alcohol, pork, gambling, or adult entertainment.
It also demands total transparency. So that means no hidden fees, no unclear pricing structures, and no hoarding of essential goods to artificially manipulate market prices.
Every single transaction has to be clear, tangible, and free from exploitation.
Which, okay, this brings up a massive logistical problem. And I know you listening are probably wondering this right now. If a bank cannot charge interest on loans, and they can't pad their margins with hidden fees, how do they actually make money?
How do they keep the lights on?
Exactly. How does the institution pay its employees and stay in business?
Okay, so this is the genius of it. The lender must share in the risk of the transaction. If you take interest out of the equation, a financial institution has to earn its profit through shared risk, asset-backed profit sharing, or direct service fees for tangible work.
So they have to actually do something.
Yes. If the bank does not take on any risk in the transaction, any extra money they make is simply classified as interest, which is, as we established, forbidden.
Okay, let's walk through the actual mechanics of how this works, because this is fascinating.
Okay.
Let's start with Mirabaha.
Sure. So Mirabaha operates as a form of trade credit. Let's say you want to buy a delivery van for your bakery.
Okay.
In a conventional system, the bank just gives you a $30,000 loan, you go buy the van, and you pay the bank back $35,000 over 5 years.
Classic interest loan.
Right. But in Islamic finance, the bank actually purchases the delivery van from the dealership themselves. The bank owns the van. They then turn around and sell it to you on a deferred payment plan for an agreed-upon fixed markup. So, say $35,000 total.
Okay, so the bank takes on actual inventory risk there.
Yes, they do.
They are acting as an active merchant, rather than just a passive lender wiring you cash. If the van gets damaged on the lot before I take possession of it, or if I just suddenly back out of the contract before the final sale, the bank takes the financial hit.
Exactly. They have actual skin in the game.
That is so wild to think about from a Western banking perspective. What else do they use?
Another really common instrument is ijara, which functions like lease finance. So going back to your bakery, maybe you need this massive, expensive industrial oven, but you don't want to buy it outright.
Okay.
The bank purchases the oven and leases it back to you for a specific period. The bank retains ownership of the asset the entire time, and they recover their original capital plus a profit margin through your monthly rental payments.
Got it. So it's essentially a rent-to-own model, but the bank holds the physical asset on their books. Now, buying vans and leasing ovens makes sense for tangible goods, but what about funding a startup?
That gets a bit more complex.
Yeah, how does a bank invest in a new business without charging interest on a commercial loan?
That is where equity and joint venture instruments come into play. primarily Mudaraba and Musharaka.
Okay, let's start with Mudaraba.
So Mudaraba is a specific type of partnership. The bank provides 100% of the capital, and the client provides the expertise, the labor, and the management.
And the profits from the business are shared based on a pre-agreed percentage.
Yes. But here's the really critical mechanism. If the business fails, the bank loses its entire financial investment.
Wait, really?
Yes, the client loses all of their time, sweat equity, and effort, obviously, but they do not owe the bank the money back. The bank absorbs the financial loss entirely.
Wait, if the bank absorbs the entire financial loss in Mudaraba, aren't they just going to be incredibly stingy with who they fund? I mean, doesn't this stifle innovation if banks are terrified to take on all the risk of a startup failing?
You've hit on the exact reason why banks rarely use Mudaraba to fund new businesses.
Oh.
Yeah, the risk profile is simply too high for a standard retail bank. Instead, banks predominantly use Mudaraba on the deposit side.
Oh, interesting. How does that work?
Well, when you open a savings account, you are the one providing the capital, right?
Right.
So the bank acts as the entrepreneur, using your deposits to invest in Sharia-compliant businesses. If they make a profit, they share it with you. If they make poor investments, your deposit actually loses value.
Wow. That completely changes the relationship between a person and their savings account. You aren't just like parking your money in a vault.
No, not at all.
You are actively hiring the bank to manage an investment portfolio for you. Okay, so what about Musharaka?
Musharaka is a true joint venture. Both parties provide capital, both share the profits, and crucially, both share the financial losses proportionally based on their initial equity contribution.
Okay, so it's more balanced.
It is, however, just like Mudarba on the financing side, retail banks generally avoid Musharaka too.
Why is that?
Because it requires the bank to be deeply involved in the ongoing day-to-day management of the project to protect their investment. And frankly, banks prefer a more hands-off approach.
They don't want to be running a bakery.
Exactly.
Okay, so moving from equity to debt markets. Conventional finance relies heavily on bonds, which are really just debt instruments that pay a fixed interest rate. Since Islamic finance cannot use traditional bonds, how do governments or large corporations raise massive amounts of capital?
They use an instrument called sukuk.
Sukuk.
Yeah, a sukuk is often referred to as an Islamic bond, but it operates very differently. Instead of lending money and receiving interest, sukuk investors are purchasing a proprietary interest in the cash flows generated by an underlying asset.
I think this source used a really good analogy for this. Think of it like a toll booth on a highway.
Yes.
If a government wants to build a new highway, they issue a sukuk to raise the funds. You, as the investor, don't own the asphalt, but you own the right to collect a percentage of the quarters dropped into the toll booth for a set number of years.
Right. You are getting a return based on the actual physical performance of an asset, not just a guaranteed interest rate.
That makes total sense.
And there is a vital distinction to make here between asset-backed and asset-based sukuk. Most of the market is asset-based, meaning you own the cash flows, the toll booth quarters, but you do not have a legal claim to the physical highway if the government defaults.
Okay, so it carries more risk than a true asset-backed sukuk.
It does, but it still successfully ties the financial instrument to something real happening in the physical world.
We also need to touch on salam and istisna contracts. Salam involves paying the spot price in advance for specific fungible goods to be delivered in the future.
Right, which is often used in agriculture where a farmer needs cash right now to buy seeds for a harvest they will deliver in, say, 6 months.
And then istisna is similar but specifically tailored for manufacturing, right?
Exactly. So if you need a contractor to build a customized apartment complex, an istisna's contract locks in the price, the exact materials, and the delivery timeline up front.
And the payments can be made in installments as the construction reaches certain milestones.
Yes. And by locking in every single detail, the system completely removes gharar.
Right, that excessive ambiguity. Everyone knows exactly what they're paying, what is being billed, and where the risk lies.
Exactly.
Okay, so now that we understand the mechanics, we need to look at how this theory actually performs in reality. And the source uses Kenya as an incredible case study for this.
Yeah, Kenya is a fascinating example. Over the past couple of decades, Kenya has actively positioned itself as the hub for Islamic finance in East and Central Africa.
Which wasn't easy to do.
No, to make this happen, they didn't just, invite Islamic banks in. They had to structurally amend their national banking laws to accommodate these exact asset purchasing and profit sharing models we just talked about.
Because their old laws were entirely built around interest.
Exactly. But once they made the changes, the explosive growth that followed is staggering. Two fully fledged Islamic banks launched in the market, Gulf African Bank and First Community Bank.
And didn't they just take off immediately?
They really did. Within just 1 year of opening their doors, they commanded 1% of the gross assets in the entire Kenyan banking industry.
Which is huge for a brand new sector. And the profitability timeline is what really stands out from a financial perspective. Gulf African Bank managed to break even in just 2 years. First Community Bank reported solid profits in 3 years.
Which is incredibly fast. For context, conventional interest-charging banks that launched in Kenya at the exact same time were still struggling to show any meaningful profit.
Well, they managed to tap into a massive, historically unbanked demographic. I mean, before these institutions existed, a significant portion of the Muslim population simply kept their money out of the banking system entirely because they could not reconcile their faith with interest-based loans.
Right, it was under the mattress.
Exactly. But these banks didn't just win on religious alignment. They won by offering highly customized products that solved real, everyday problems for people.
Yeah, they introduced products like the Hajj or Labeka accounts. These are specialized savings vehicles designed specifically to help Muslims plan and save for the financial burden of the annual pilgrimage to Mecca.
They also launched the Anisa account, which is a banking product targeted specifically at women. It offers specialized saving structures and higher returns to encourage financial independence and wealth building.
Which is brilliant marketing and product design.
But the appeal of this system, it goes far beyond religious demographics. And this brings us to an International Monetary Fund study that looked at how Islamic banks performed during the 2008 global financial meltdown.
Oh, this study is so revealing. The IMF researchers investigated the effects of the crisis across global markets and found a really stark contrast. Islamic banks fared significantly better than conventional Western banks.
I mean, they didn't just survive, right?
No, in fact, they actually contributed to financial and economic stability in their respective regions, while the rest of the global market was just collapsing.
Which, when you look at the mechanics we just outlined, it makes perfect sense. They survived because they structurally could not touch the assets that caused the crash.
Exactly. The entire global meltdown was fueled by excessive uncertainty and speculation. Garar and Macer.
Right. Conventional banks were trading highly complex, leveraged derivatives based on subprime mortgages. They were placing massive bets on synthetic instruments that almost no one fully understood.
While the conventional sector was trading synthetic debt, Islamic banks were insulated because their capital was fundamentally linked to the real sectors of the economy.
They were buying delivery vans.
Yes, buying delivery vans, leasing industrial ovens, and sharing profits on real physical businesses. They didn't have exposure to the toxic financial engineering that brought down Wall Street.
So what does this all mean for you listening? Even if you aren't Muslim, a banking model that is structurally prohibited from gambling with your deposits is an incredibly attractive value proposition.
It offers a level of stability that conventional banking really struggles to guarantee.
But, and this is a big but, for all its resilience, this industry is currently hitting some massive roadblocks on the global stage. Expanding Islamic finance globally is proving to be incredibly difficult.
Yeah, it's not all smooth sailing. The most immediate bottleneck is a severe lack of human capital.
Right.
There is a massive shortage of experts who are trained to actually operate these banks.
Because finding someone who understands the complex mathematical modeling of modern global finance is hard enough. But finding someone who understands that and also has a deep, rigorous understanding of Sharia law and Islamic jurisprudence, that is an incredibly rare combination.
It really is, and that shortage of expertise bleeds into a much larger structural issue, which is the glaring absence of uniform standards.
Oh, this part sounded like a nightmare.
It is.
Yep.
There is no globally harmonized set of accounting, auditing, or credit analysis practices tailored specifically for Islamic banks.
Because normal accounting doesn't fit.
Exactly. When a bank's fundamental operations involve profit and loss sharing, or buying and reselling inventory, standard conventional accounting models simply do not work. How do you properly disclose your risk profile to an international investor when the rules of your ledger look completely different from the rest of the world?
And wait, if Sharia law is interpreted by scholars, what happens when a supervisory board in Kenya approves a specific Murabaha contract, but a Sharia board in, say, the UK or Malaysia looks at the exact same contract and deems it unacceptable.
That happens all the time.
So how can you possibly build a cohesive global financial system when the fundamental rules of what is allowed can change depending on which country you are standing in?
You've just described the single biggest challenge the industry faces today, that fragmentation. Different regions have varying interpretations of what constitutes strict Sharia compliance.
Which corporations must hate?
Oh, they do. For a multinational corporation trying to issue a global sukuk, that lack of harmonization creates massive legal and financial uncertainty. Investors want predictability, and differing scholarly interpretations create a lot of friction.
There is also a severe liquidity problem, right? Because conventional banks manage their daily cash flows by parking excess money in highly liquid, short-term, interest-bearing bonds.
Right.
But because Islamic banks cannot earn interest, they struggle to find high-quality, short-term investment instruments to manage their day-to-day liquidity safely.
And secondary markets for instruments like sukuk are also deeply underdeveloped. If you buy a conventional bond, you can sell it to someone else in seconds. Selling a sukuk on a secondary market is much, much more difficult, making the capital less fluid.
And then you run into the logistical nightmare of trying to operate an Islamic bank inside a non-Muslim nation.
Ah, the regulatory clashes are severe.
Yeah. You are dealing with regulatory and taxation frameworks that have been built from the ground up over centuries to handle interest-based debt. When an Islamic bank tries to operate in that environment, the systems just fight each other. Take a Mirabaja contract for a house, for example.
Okay.
The bank buys the house and then resells it to you. Well, in a conventional system, the government charges a stamp duty or property tax every time a piece of real estate changes hands.
Meaning the transaction is taxed twice.
Exactly.
Okay.
Once when the bank buys it, and again when you buy it from the bank. It artificially inflates the cost of Islamic banking products, making it incredibly hard to compete with conventional banks that just issue a single mortgage loan.
It is like trying to play a completely different sport on the same field using a completely different rule book, while the referees only know how to call fouls based on the conventional rules.
That's a perfect way to put it.
Yes.
There is also no universally accepted mechanism for dispute resolution when these cross-border transactions inevitably hit a legal snag.
Right. They are forced to operate in a global ecosystem that has century-old, deeply entrenched standards designed for an entirely different philosophy of money.
So we've journeyed from a fundamental philosophical mandate, where economic activity is viewed as worship and demands a balance between individual wealth and social good, to the absolute prohibition of interest and speculation.
And we've explored how those prohibitions force the creation of really innovative risk-sharing instruments that tie capital directly to physical assets.
Right, and we've seen how this model provides real stability in markets like Kenya, even as it fights a massive uphill battle for global standardization.
You know, the research highlighted that IMF study showing Islamic banks survived the financial crisis specifically because they tied money directly to tangible assets rather than speculative bets.
Right, the delivery vans over the derivative.
Exactly. And as the conventional global financial system continues to face massive, devastating cycles of boom and bust fueled by highly leveraged debt and derivatives, it raises a really fascinating question for you to explore on your own.
Oh, I like this.
Could secular Western banks eventually be forced to adopt these very same profit and loss sharing principles, not for religious reasons, but purely as a matter of long-term economic survival?
Wow. That is definitely a thought that will stick with you, because maybe the best way to prevent that snowball of compound interest from eventually causing an avalanche is to put down the snowball, pick up a shovel, and actually plant something real in the ground. Thank you for joining us on this deep dive. We'll catch you next time.